Stay informed on earnings trends and analysis in Zacks Earnings Outlook.
We're going to wrap up the Q3 earnings season now with our research director, Shiraz Mian. He's going to put it all in nice perspective for us.
Sure, I'll try my best.
And look forward, too, to Q4. But first things first. So as we wrap up the Q3 earnings season, same as always, retailers last to report.
Sure.
As those reports come in, you're seeing a mixed picture among the retailers. How?
That's right.
How so?
So in two ways. If we compare what we saw from the retail sector in Q3 to what we have been seeing from the retailers, say, over the past year or the past couple of years, and then how the retail sector results compare to what we saw from the broader corporate sector, from the S&P 500 as a whole. And in both ways, they were a mixed picture. I have a slide to share that with folks.
Sure.
And what we have here is we are comparing the growth rates, Q3 growth rates for retail, earnings and revenue, with what we saw from the same group of retailers in the 4-quarter average and the 12-quarter average. And the earnings growth is relatively better in terms of what we saw from these retailers in previous quarters, but the revenue growth is on the weak side. Similarly, the proportion of positive surprises, earnings surprises are about the same as historical levels. Revenue surprises are a tad below the 4-quarter average and notably below the 12-quarter average. In fact, the positive surprises and revenue surprises for the sector are some of the lowest and weakest of all the 16 sectors in the S&P 500. And we saw that within the subgroups of the retail sector. Earlier on, when the online vendors reported, folks were disappointed. The restaurants numbers were so-so. Overall numbers from the department stores were okay, but there was a function of low expectations, and then those guys cutting expenses real hard.
It's interesting you say the restaurant numbers were just so-so, because according to published reports, we have people eating out more now than ever.
Yeah, it is, but it's relatively a moderation in that pace compared to 2-3 quarters back.
I see.
So it is an improvement over what we have been seeing, say, a year or 2 years back. But that momentum that we saw, and some folks ascribe that to what we saw on the gasoline prices front and the savings on those are now in the rear view mirror, and that's showing up in the comp sales for the restaurants as well.
Okay.
And just to compare what we saw from retail with what we saw for the S&P 500 as a whole, we have 485 companies in the S&P 500 already reported as effectively the entire group. And you could see there that earnings and revenue growth is notably better than what we have seen either in the previous quarter, in the 4-quarter average or the 12-quarter average, and same with positive surprises. Earnings and revenue surprises are clearly above historical levels. So while the overall earnings season was fairly positive, we didn't really see that in the retail sector results.
All right, and so Q3 on the whole, this comparison, is that the bottom line for Q3 on the whole for the S&P 500?
Yes, it's almost the bottom line. So the exact bottom line is when the last company reports. So we are not there yet, but it's almost that. And the final bottom line in terms of earnings growth is positive earnings growth in Q3, ending the earnings recession that had been in place for many quarters now. In fact, Q3 is the first positive earnings growth after 5 quarters of back-to-back earnings declines. And this is despite the fact that energy was a big drag in Q3. The expectation is that energy becomes less of a drag from Q4 onwards. So this came ahead of time, and there was welcome and positive.
All right, so that being said, we have to talk about corporate earnings going forward in light of the Trump victory that we just witnessed. And now that we've turned the corner on this earnings recession, as you say, we turn our attention to trade reform that he's been talking a lot about on the stump. Anything there, as far as we know it at this point when we're talking today, November the 22nd, that you can see that will negatively impact corporate earnings?
Hard to tell. But let me talk about the positive side first. And the positive side is that if folks need a rule of thumb to look at earnings in the aggregate, look at revenues. If revenues grow, earnings will grow. The rule of thumb for revenues is the economy. If the economy grows, revenue will grow. In fact, if you plot global GDP growth versus the revenue trend for the S&P 500, they literally just move in sync with each other. So the expectation is that the new administration will unshackle the economy, which will give us more growth than we have seen over the last 5, 6, 7 years. If there's more growth, there's going to be more revenue, and there's going to be more earnings for corporate America. And that's the positive story.
Right. But you can't discount the fact that those trade tariffs that have been coming up in conversation could have a negative impact on the multinationals.
So we don't know. And that's the big uncertainty at this stage. In fact, the market seems to be totally discounting the potential for disruption and uncertainty if the president-elect will make the trade issue a more important one earlier on in his administration. If we open up these trade deals, then that'll be problematic for a lot of these multinationals. We should keep in mind that roughly 40% of the S&P 500 earnings come from abroad. There are many sectors, including some key important ones like technology, that earn more than half of their revenues abroad. So if we tear up NAFTA, if we are be getting out of the TPP and not really doing it, and if we are going to be slapping sanctions, not sanctions, but duties and tariffs on imports from China, then that's problematic for a host of companies that have been actively investing abroad and using those investments abroad to help prop up their margins and growth.
And just to complicate matters a little bit further, how does the dollar figure in? Is that a wild card?
That is a wild card. And we have seen the dollar move in line with the rise in long-term Treasury bond yields. Part of that is a reflection of what the market is expecting the Fed to do. There is almost a unanimous consensus in the market now that this next meeting we will see that long-awaited rate hike. But then on top of that is these growth expectations that we touched on before. If we have tax cuts from the new administration simultaneously, while there is an increase in fiscal spending, there is talk of infrastructure spending, there is talk of more defense spending, then that's something new for the U.S. economy that we haven't seen over the last 10, 15 years. So greater inflation expectations, that's pushing yields higher and is pushing dollar higher too, and that could be problematic for earnings as well.
Tax cuts. There's talk of cutting the corporate tax rate. So maybe these companies are going to free up and start spending some of that cash they've been sitting on all this time?
It's possible, though the possibility of those companies bringing the cash and buying back their own shares is also there. The key will be how much money comes back to the country, and if it does, that by itself will have an impact on the value of the U.S. dollar as well. So tax cuts net is positive, but not everyone will win. There will be clear winners and losers out of that. Capital spending could improve, and then on the flip side, it may not.
All right. Well, hopefully there will be no other wild cards out there that'll help to mark down earnings going forward. On that note, let's take a quick gander into Q4.
Yes. So I have a slide that I want to show, which shows the evolving growth expectations for Q4. And as you could see, at the beginning of the quarter, late September, early October, the expectation was for 5.5% earnings growth in Q4. As of now, it's for growth of 3.2%. That's a negative trend. But I must add that the magnitude and pace of declines that we saw for Q4 earnings compares favorably to the past 4, 8, or even 12 quarters. It's a bit on the higher side relative to Q2 and Q3, but on the whole, shows that the earnings picture is improving. There's less negative revisions, and we discussed the potential impact of the incoming administration. I think that, combined with what we saw in Q3, should add to more confidence in the overall earnings picture. I know we dwell more on the negative aspects of the incoming administration's policy package, but on the whole, I think the earnings picture is better now than it was 2 months ago.
Okay, and that's an important note as well. And those reports for Q4 begin rolling in after the new year begins.
That's right.
And so we will be doing our next chat here with you once that starts.
Sure.
In the meantime, don't forget to keep up with Shiraz earnings preview commentaries in written form, as well as his written earnings outlook commentaries on our website, Zacks.com, right there on the home page for you to link from. With Shiraz, I'm Terry Ruffalo.